Hi, accounting class. It's an awful day to do accounting, man. I don't want to do this. Why are we doing this? No, I'm just kidding. It's actually a great day to do accounting. Here we are in chapter 7. This is over receivables and cash. Alright, this first part is just going through all the different terminology we're going to see throughout the lecture today. You feel free to read through this, but we're going to hit on these individually when we define them throughout the lecture. Types of receivables. There are two major types that we're going to talk about: accounts receivable and notes receivable. Accounts receivable is the one that we're most familiar with. Remember, this is when somebody else owes us money. It's called accounts receivable. We expect to collect it. These are generally short-term in nature, 30 to 90 days. There's generally no interest associated with them. And they're reported on the balance sheet at their net realizable value. Like we talked about, not all customers are going to pay us what they owe us. The customers who are not going to pay us what we expect are not going to pay us what they owe us is the allowance for doubtful accounts. So if we do not expect to receive the receivable, it's allowance for doubtful accounts. So we take the gross AR, the total amount owed to us, minus the payments we do not expect to collect, and we'll get to the net realizable value, and that's what it's listed on the balance sheet. Actually, they list both the AR and the allowance on the balance sheet and net it together to equal the net realizable value. But net realizable value is an important term to know. Notes receivable we're going to look at later. These generally have interest associated with them, so we're going to learn how to account for the interest. There's a maker. This is the borrower. They're issued to a payee, the creditor. The creditor is the one lending the money, so the payee is lending money to the maker. This is a promise to pay a fixed amount for a fixed length of time and a fixed interest rate. So this has more legal bearing. If there's any dispute between the parties, this one has a more formal legal agreement of credit between the two parties. Both of these are legal debts. If you owe an AR or notes receivable, both are legal debts. This just has a formal legal agreement, so it has stronger legal support. Alright, accounting for receivables. We're going to start just with accounts receivable. We're going to talk about notes receivable later. Just under accounts receivable, we have two methods to account for the receivables. We have the allowance method and the direct write-off method. This first one is the GAAP method. This is required by GAAP. So if you have large amounts of inventory, this is a method companies have to use. Therefore, this is the one we're going to emphasize the most in this lecture. This method, what it does is estimates how much of receivables are likely to be uncollectible. Estimates how much of accounts receivable are likely not to be collectible. And then it sets up an allowance for it. The allowance goes to an account called allowance for doubtful accounts. This account is a contra asset. A normal asset has a debit balance. A contra asset has a credit balance. So this can be thought of like a negative asset. And conceptually, allowance for doubtful accounts represents the monies that we do not expect to collect out of AR. The direct write-off is not allowed under GAAP. But it's okay to do if your balances are immaterial. Immaterial means they're not big enough to make a difference in someone's decision. Direct write-off we're going to see is the easier approach. It does not set up an allowance, therefore it doesn't have ways to set up the allowance. The only thing it does is it's going to expense a specific account when management deems it to be uncollectible. That's the only thing it's going to do. It's not going to do all the setting up an estimate and different ways to do it that we're going to see on the allowance method. Why does GAAP like the allowance method and not the direct write-off method? It comes down to the matching concept. So we want to get the revenues and the expenses in the proper period. It's very important in the accounting world to get the revenue and expenses in the proper period, so we show a fair scorecard of a business during that accounting cycle. Alright, AR and allowance should always be thought of together. So AR and allowance, these net two, we're going to see hopefully see a balance sheet later that's going to show you how they look on the balance sheet. Alright, the allowance for doubtful accounts. Hopefully this looks a little bit like a bucket. That's all I'm trying to show here. Year-end entry fills up the account, so we're going to see the adjusting entry that we make at year-end to fill up the account. And then during the year we use funds out of this. So we set aside, we're not actually setting aside cash. That's the only misconception here. We're setting aside earnings. We're effectively setting aside those earnings and allowance account to cover people in the future who do not pay us what they owe us. Alright, so the allowance method, we're going to estimate how much of receivables are not likely to be collected. and then it sets up an allowance for them. And again, what conceptually it represents, the allowance for doubtful accounts represents the total amount we do not expect to collect. It is a contra asset account. It is a negative asset account. Therefore, it has the normal credit balance. Alright, we're going to have one entry to set up the allowance at year end. We can estimate this one of two ways. We can estimate it under the percentage of sales method or the aging receivables method. We're going to see both methods on the next two pages. But first, we're just going to get to the journal entry that fills up the bucket, and we're going to see the journal entry that takes money out of the allowance account. So assume a business had 105 of AR at the end of the period, and they believe 4,000 is likely not to be collected. They haven't told us how they got to the 4,000. We're going to address that in the next two pages. But right now, we just expect out of the total 105 that we have, we do not expect to collect 4,000 of it. So what we're going to do, start a journal entry. Let's think. We're going to set this up in the allowance account. The allowance account has a normal credit balance. We're adding to it, so we're going to credit the allowance account to effectively set aside $4,000 of earnings. The debit goes to an account called bad debt expense. Alright, so this is the year-end entry, the adjusting entry made once during year-end to set up the allowance. The next one, I'm going to change the date here. It's more fair that it'll be something else. I'll change it to my birthday. But it's going to occur during the year. Alright, so a customer hasn't paid his receivable in $610 and over a year. What we're going to do is write off that person's specific account. Now we don't have to hit bad debt expense here because we've already set aside money for it. We've already set aside the earnings for it. So what we're going to do once we have the allowance set up, we're going to use the allowance. To use the allowance, we're going to take money out of the allowance. So we're going to do the debit balance. Remember, it has a normal credit, so a debit takes money out of the allowance account. And we're going to write off this person's account. If we don't expect them to pay, we're going to write off their AR. We're going to reduce their AR account. So their accounts receivable for this person is going down by $610. So note, there's no expense here. We've already recognized the expense at year end. This is why it is the GAAP method, because we got this expense in the prior year where it belonged, because that's where we made the sales and the receivables. There's no expense right here. All we're doing is using the allowance that we set up at year end. Alright, now we're going to go back to the previous problem. How did they determine this 4,000? So we're still talking about AR. We're still under the allowance method. How do they determine how much is not likely to be collected? This is a little bit of a complicated question. Like if you loan money to a friend, when do you know that that friend's not going to pay you back? The answer is you really don't. There's no scientific way to really determine that. Just as more time goes on, you're just likely to say, well, probably not going to see that money again. So there's no real scientific way to do this, but we can tell based on prior history, based on sales, for example, how much are likely not to be collected just based on prior history. Alright, so this is one of the two methods that we're going to learn. Here we're going to set up the allowance using the percentage of sales method. So we're going back, we're going to see a very similar entry to this one. We're setting up the allowance. So those are the two accounts. This isn't going to change. Second, I got to change that. And the date, this will be year end. This is the year end adjusting entry that they set up at year end. Under this approach, management believes 1% of sales on account are uncollectible, and they had credit sales of $300,000. So $300,000 times 1%. $3,000. That's the amount for the journal entry. So this one of the two are simpler. We're going to see the aging schedule next time has more steps to it. But here you just multiply the amount of credit sales times the percent that management believes is uncollectible, and you have your amount. This one does not consider the beginning balance. The next approach does. So notice we didn't do anything with this number. We can cross this out actually. It does not consider the beginning balance under this approach. That's one of the confusing things between the two approaches. There's a reason for it. On this approach, all we're doing is looking at sales for this period. We're not looking at sales from prior periods, so we can only make assessments about this period. This period we had $300,000 in sales. We expect 1% or $3,000 of them to be bad, so we set that up in the allowance. We don't adjust our ending balance to be $3,000. This is all you do. Multiply the amount of credit sales by the given percentage. So in this case, it was 300,000 times 1%. All right, the other method. So this is the second. We're still under AR, accounts receivable. We're still under the allowance method. We're trying to estimate the amount we set up at year end. In this case, we got to 3,000. We may get to a different number under this approach, and companies can choose either one of these approaches, an estimate based on sales or an estimate based on receivables. This one's going to have something called an aging schedule. The theory here is that the longer that an invoice is outstanding, the less likely it is to be collected. So what they do is they list out all their invoices. Well, we get an invoice if we owe somebody else money, but we also issue invoices to bill other parties. So these are the accounts receivable invoices they issued. They have the total amount for each invoice. So the 9950 represents the total amount of accounts receivable for this business based on this schedule. And then they age the receivables. They look at the individual invoices and they figure out how old each individual one is. In this case, this one's over 90 days, so it's in this column. This one is between 61 and 90 days, so it's in this column. And they do that for each one. The 1500, the 2750 falls in that age category, and so on and so forth. What we need to do next is add up the entire column for each one of these. This one only has one number, so it's real easy to add up. It's 1600. This one also has one number, but it's a summation of this entire column. This one's going to be 3,800 if you add these two numbers together. And the last one will be 1,800. Alright, the next step, these percentages are going to be given by management. They're based on past history of what we expect not to be collectible. For you in this class, that means they're always going to be given in the problem. There's no way that you're going to be able to figure them out without historical data. So our only step next is to multiply each one of these. 1,600 times 1% is 16. 2,750 times 4% is 110. 3,800 times 15% is 570. Let me reinforce one thing. The last one, 1,800. If you're typing this in a calculator, you don't type. You got to type in 0.9. You got to move over the decimal place twice, right? 1, 2, 0.9. Then you get to the 1620, which we should see here. Yes. Alright, our last step is to add up all of these different categories. These are the total amounts we don't expect to collect out of each age category. If we add up all four numbers, we get to the total uncollectible accounts receivable. Alright, now we finished our aging schedule. The total AR is 9950. This is the total amount owed to us. The 2316 represents the total amount we do not expect to collect out of AR. Alright. So 2316 is the most important number in that schedule. That's the number that we're going to carry forward. This is our target ending balance. Target ending balance. So we're not just simply going to make our journal entry for 2316. We are going to have the same two accounts, right? The same two accounts here to set it up. We're just setting up the allowance. So it is the same two accounts. Again, we're just changing the amount. We're doing a calculation for the amount. Alright, in this case, let me go and show you the T accounts down here. This one's saying the beginning balance for the allowance account had a credit of $400. So if we look at a T account here, credit of $400. And we want the ending balance to be 2316 because that's the total amount from the aging schedule that we do not expect to receive. So if you look at the math here, 400 plus something equals 2316. If you can set it up algebraically and you can solve for this, but once you do, it'll be obvious that you need to subtract to get to this question mark, and that's why this one is subtracting. So it'll be 2316. We need to add, just like a checking account. If you had $400 in your checking account, you need to pay a bill of 2316. You would need to add the additional amount to the checking account to get there. So it's the same concept. So it'll be 1916. So this one had a credit balance. We subtracted because of this is how it's going to look. A credit balance here, you're going to have to subtract the 2316 minus the 400 to get to the missing amount. Alright, setting up the allowance using the aging receivables method. This time it's the same problem, but we have a debit balance. So we're going to be looking at this T account. The allowance account is based on estimates. So it's very possible for this allowance account to have a debit or credit balance because it's based on estimates. Humans are not the best at perfectly estimating what's going to happen in the future. Alright, so if this allowance account had a debit balance, this also means it was overdrawn during the period. Like, a credit balance is a positive balance, a debit balance is a negative balance in the allowance account. Its normal balance is a credit. So this represents the allowance account is overdrawn, or that we've used it too much. We've had more bad debts during the year than we estimated at year end. Alright, it's the same two entries. But we're going to see here we need to add. If we're going back to the checking account example, we had our account's in bad shape. We have a negative $400 in our checking account. If we had a negative $400 in our checking account, we need to contribute that $400 first just to get our balance to zero. Then we need to contribute another $2,316. So in this case, we need to add. So in the previous one had a credit, we subtract. This one has a debit, so we add the balance. We need to contribute the $400 plus the 2316. Both of these get it to the same spot, 2316 ending balance. They just started with a different beginning balance. Alright, on to the next page, the direct write-off method. So we're still under accounts receivable, but we're no longer in the allowance method. This splits off. This is the non-GAAP method, and we're going to see this is pretty short because direct write-off only does one thing. Is not the GAAP approved method. Not. So we can't use it unless we have immaterial receivables. But some businesses do have immaterial receivables, like restaurants. They get most of their receipts in cash after the customers pay, so they don't have too much in receivables. It would be completely okay for them to use this method. The direct write-off does one thing. It writes off an account when management deems it to be uncollectible. That's what it does. It writes off an account when management deems it to be uncollectible. It does not set up an allowance, and therefore it doesn't have the allowance account. Therefore it doesn't have two ways to set up the allowance. Alright, so let's see the only journal entry that we should see under the direct write-off when management deems an account of $735 owed. Alright, corrected that. $735 owed by C. Drexler is uncollectible. Alright, I want to change one of these dates again. This would happen during the period. The other ones typically are going to happen at year end, but we're going to go ahead and change it to February 3rd. We'll refill it, because this happens sometime during the period. It doesn't happen at year end. Alright, what this method does, management deems this account to be uncollectible. We don't have an allowance set up, so at this point under the direct write-off, we only have one choice to recognize as an expense. So we're going to hit bad debt expense here. If this was the allowance method, this account would be the allowance account because we would have set it up at year end. But this approach didn't set up an allowance, so it doesn't have an allowance to use here. Just like the allowance method, it's going to write off their receivable. If we don't expect that person to pay, then we write it off. It's not fair to keep it on our balance, keep the AR in the account if we don't expect to collect it. Alright, moving on to the other subject we're covering today. So now we're out of AR, we're into notes receivable. So we see an example of a note. This looks a lot like a check if you're used to seeing a check, but let's see, we have something called the face value. It could also be called principal, so face value or principal. I think we're going to stick with the term face value for this course. The term is how long it is. In this case it's 90 days. It could be 60 days, 90 days, 180 days, or anything that's defined in this contract. We have the payee. Alright, this is the party that's going to receive the payment on the due date. We have the interest rate. The interest rates are a little tricky if you see them on financial documents. This 6%, they're not going to earn over 90 days. This 6% is a interest rate. All interest rates are assumed to be yearly interest rates unless specifically stated otherwise in the document. So 6% is an annual rate that they're going to earn over an entire year if they held it for an entire year, but they're not going to because it's only for 90 days. So we're going to see how we adjust for that in a second. The due date, this is going to be 90 days after the issuance date. And then the maker's signature. This is the party that's borrowing the money. So they're going to borrow it for 90 days and then repay it to this party. And they're going to repay not only the face value, but the interest associated with it. We're going to calculate that in just a second. Alright, the interest is equal to the face value times the interest times the term measured in years. For our examples, we're going to consider, like all other textbooks do, that there are 360 days in a year. I understand that there are actually 365.25 days, if we're going to be precise. But the 360 makes the interest rate calculations nice and neat in a textbook, and it's common among textbooks to do that, so we'll follow their example. Total interest for this note then is going to be equal to the face value of $10,000 times the interest rate of 6%. And then times the term. We're going to measure this in years, so it's actually going to be 90 out of 360. It's only 90 days out of the 360 that we're defining as a year. So we see the face value times the interest rate. Remember to convert this interest rate into its decimal form by moving over the decimal two places. And then we have the term 90 divided by 360, or $150 of interest. Alright, the maturity value of a note is its face value plus the total interest. In this case, the maturity value is going to be equal to the $10,000 plus the $150. So the face value plus the interest equals the maturity value. Alright, let's get into notes receivable and how we actually do the journal entries, recording the receipt and collection of a note. Here's a simplifying rule. For notes, notes will always go on the books at its face value. The face value of this note is $10,000. It will always go on at $10,000, always come off at that face value, 100% of the time. Alright, receipt of a note. On 5-1, assume that the accounts receivable of Bob Sugarland has been outstanding for 90 days. Hey, it's signed a promissory note we saw on... Oh, okay, so this is the one we're going to receive. So Bob Sugarland's, we are United Corn Farmers International. Bob Sugarland's been owing us money for a while, and he hasn't paid. So now we're going to make him sign a note, or allow him to sign a note, and we're going to charge him some interest too, since his balance has been outstanding for some time. So he signed the note. We're just going to account for it. This is like accounts receivable, but it's not. It's going to be called notes receivable, a specific type of receivable. It's similar to accounts receivable, but like we said, it has interest generally associated with it, and it's generally longer in time. And since he already owed us the money was in accounts receivable, we're going to take it out of accounts receivable. So we're going to take it out of his accounts receivable and put it into notes receivable. Alright, the 3 months will pass, so 7/29 is going to come eventually. The due date of the note. Alright, so Bob Sugarland paid the full note. Remember, we're accounting for it as if we're United Corn Farmers, not Bob. So we're going to receive the cash. We're going to receive $10,000 plus $150. We need to take the note off. Remember, notes always go on at face value, always come off at face value. Oops, that's way. Alright, okay, that's the interest revenue. Whoops, did the wrong one. This one's the note. The notes always go on at face, always come off at face. So we have 10,000. Notice when we put it on the books, it goes on as a debit. When it comes off the books, it comes off as a credit. It's a receivable. It has a normal debit balance. And then the remaining part is the interest revenue. Again, we use the same formula, the 10,000 times 6% times 90 over 360. It's the same one we calculated on the previous page because we're talking about accounting for this note. Alright, notes receivable. The previous problem we saw was a little simpler because all of it occurred in the same year. But if we have a note that starts near the end of the year and it crosses over our year end, we are required to accrue for the revenue that we've earned as of year end. Alright, difference between a fiscal year is a business year. It's their accounting year effectively. It doesn't have to end on December 31st. It can end on any month of the year. For this example, we're going to assume their year end is May 31st. So this business's fiscal year end is May 31st. So they have to close their books and get everything ready as of May 31st to report their information to the financial report their information on the financial statements. Alright, all the way back from chapter 1, revenue is recognized when it's earned. Alright, so if we have a note and we hold this note, we're earning interest. We're earning interest each day. We earn this interest over time. So this date is May 1st. We need to do an adjusting entry from May 1st to May 31st to accrue for 30 days of interest. The interest we've earned from May 1st to May 31st. So we must recognize the portion of interest that we have earned as of May 31st. Alright, so 5/31, which is their year end. We need to accrue for the interest we've earned. So there are going to be two accounts here. It's going to be interest receivable and interest revenue. 10,000 is the face value. 6% is the interest rate on the notes. Notice here this 30 is not a 90. Why didn't we use 90? This note is for 90 days. It says so right here. The reason we didn't use 90 is we're only accruing for the interest we've earned so far, i.e. the interest we've earned between May 1st and May 31st. Alright, so we have $50. Alright, so May 31st, their year end, they close the books and they start a new year on 6/1. But on 7/29, this note becomes due. We're the party receiving it. We're going to receive cash. This is going to be equal to the maturity value. We'll get back to it in a second, the amount. There's a lot notes. The note has to come on at face. It'll come off at face. So the note went on at 10,000. It's going to have to come off at 10,000. Alright, at year end we set up $50 that this party owes us for the note. On this date they're going to pay us the $50. It's going to be somewhere in this number, but they're going to pay us this $50. So we need to take this receivable off of our books for $50. The amount of the accrual. If we didn't take it off, it would stay on there forever, right? There's never going to be another transaction that takes that off. So we set it up at year end and we're receiving it now, so it's appropriate to remove that receivable from our books. The last amount is interest revenue. Alright, these three together will be the total amount of the maturity value. Notice we see the 150 again, the total amount of the interest, the maturity value. The only difference here is it crossed over our year end, our fiscal year end of May 31st. So we had to do the accrual for the interest we've earned as of the end of the year. And then the next year when we receive it, we had to take that receivable off and recognize the other part as interest revenue. This is because it's accounting. We had to get this revenue in the proper period. We got $100 in the current year and $50 of revenue in the prior year. Alright, the next page just reviews some of the concepts we've learned. I'm going to show this so it's revealed to people who want to complete all the notes. I'd be prepared to do an aging schedule like this on the quiz, so Philip be able to calculate the red numbers. And this takes you can just stop the video, and if you want to record these are just examples, but we went over each one of these concepts. The only difference here, they're using 365. The other instructor wanted me to add another example where they're using 365. He likes to use that in some examples. But in our class, we're going to use 360 exclusively. Alright, bank reconciliation. We're not going to look at this in detail. We're not going to have this as part of our assessment this year, but here is an example. If you're curious, if you're an accounting major, it wouldn't be too bad idea to look at this and get familiar with it. As an entry level like auditor, that's one of the first things they assign to entry level auditors is do a bank reconciliation, because it is one of the easier things to do at that level, but it's a nice thing to have in your skill set. Alright, that's really it for the Chapter 7. You can see the summary. Everything's filled out here. This is basically, if you know this information, I think you're going to be in good shape. This is all in summary form. Alright, see you guys next time for Chapter 8. Alright, bye-bye.